So this is Gerard Daché with the Government Blockchain Association. I'm thrilled to present Daryl Hubbard of the Digital Currency Monetary Authority. He's going to share some really great information about cryptocurrency, digital assets, international trade. And Daryl, I'm absolutely thrilled to have you with us. Why don't you share a little bit about your background and what you're doing?
Okay, thank you very much for having me today. Again, I'm Daryl Hubbard, a founding member of the Digital Currency Monetary Authority. We're based here in Washington, D.C. We provide digital currency, digital payments, and digital trade technology for governments and central banks around the world. I started my sort of journey in blockchain in about 2013. I, along with my team in Amsterdam, received several grants from the European Commission to build digital currency solutions for various social and civic programs throughout the EU. That work got a lot of global visibility. We was featured in it with the United Nations, the World Economic Forum, and that led to us having various collaborative engagements with other central banks like the People's Bank of China on their digital currency, CBDC, and the Korean government with their smart cities initiatives, and other central banks. We're working closely with the African Union right now and creating various digital currency solutions for the continent of Africa. But realizing blockchain for governments is a very different sort of niche than sort of the public ledger technology like Bitcoin and others. We decided that we should probably form the DCMA, which is the Digital Currency Monetary Authority, focusing on just government and central banks technology and understanding the difference between public ledger technology and government technology and how it could be evolved to meet the needs of governments and central banks. And so today I will focus on what we are doing, the innovations that we are bringing to the global trade community. Digital currency has a very critical and vital role it can play, I think, in the digital currency world. So I will share some of those innovations and technologies now. Let me see if I can share my screen. Just 1 second here. Okay, I think this is it. So let me know when you can see that.
We got it.
Okay, so let me just go to the slideshow. Again. So very good. Again, so DCMA, Digital Currency Monetary Authority, focused on decentralized digital banking technology for governments and central banks. Today, I want to share some of the use cases of digital currency in global trade. I think the most compelling opportunity that hasn't been encroached yet is the ability to have a single global currency for trade. So when Euro and the African Union have both sort of looking at creating, the Euro's already created the Euro, which is for a continent. Africa is looking at creating a single continental currency to try to minimize FX rates across the different countries in Africa. But we see this same use case should be applicable on a global scale. Think about having a global currency that everyone can use to trade without having to have currency conversions and losses and fees every time you trade between cross-border. This is, so we created actually 3 different global trade currencies today. We call it the G7 coin, the G20 coin, and the IATA. IATA is the International Air Transport Association. We actually, this is a proposal we are making to them. We created technology. They have a proven use case called the NUC, which is a neutral unit of construction, or the neutral unit of currency, they call it. It's actually what airlines use to trade between each other when you do international travel purchases. Instead of having FX rates on airline purchases, they actually have this. It's not a currency, but just they have an index of different countries that they set as standard exchange rate, and everybody uses that rate to buy and sell tickets. And it's been a very strong proven model, even though they haven't implemented it as a digital currency. But that same concept could be applied to not just the airline industry, but in the global trade industry. And there's several benefits to having to turning FX into a currency. And the main one is to be able to hold balances. So once you have a currency, then you actually can hold a balance in that currency. So if you are trading with a trading partner, and say they pay you in a certain currency that's a global currency, you can hold your balance in that currency and then turn around and pay someone else later on, right? So we are minimizing all that FX friction every time you have to do a transaction. I mean, these global trade, raw materials and commodities are a $20 trillion a year industry. That's a lot of FX conversion that's happening, right? So if we can create a single currency that the global trading community sort of adopts and accepts and can hold balance in that currency, then you can not only do we eliminate fees, you can start to earn interest on those balances. So several service providers that can take that balance, so like all the DeFi projects, and also give you maybe 3 to 5% ARI, I mean annual interest rate on that particular balance. And by being digital, there's so many enhanced fraud prevention technologies that can be adopted. I would share one that we've innovated in a second, and we could streamline trade finance payments as well. So these are just some of the major benefits I see in using a single global trade currency. I'm gonna focus on the last two, because those are probably the more innovation areas. I think the first three are pretty, self-explanatory. So let's look at.
Hey, Daryl, can I make one comment on
Sure.
the friction? So most people don't recognize exactly how complex and how many transactions happen in the supply chain, right? So if you're looking at, say, flowers, for example, I mean, flowers just in the shipment of flowers from the field to the store requires 20 separate signatures and transactions. And when you start looking at more complex things like pharmaceutical supplies, right, and how they're packaged and repackaged, the amount of FX friction that typically exists in many of those supply chains is incredible. So this concept of eliminating, I think the other ones are more interesting, and I'm glad you're going to go into it. But the eliminating FX friction is really a huge impact in international trade and supply chain. So I just want to make that comment real quick.
Yeah. Trade can go through many correspondent banks, right? To send money from U.S. to some, remote area of Africa. If you're buying some coffee or whatever the commodity is, it can literally go through several chains of banks in order to get there. And each bank is charging their markup in the FX rates to make that conversion, right? So having a common currency, again, starting with at the continental level could be a good start, but I think global would be the ideal solution. But having even a continental currency in some, Africa, Europe, Europe is so. We was invited just last month. The president of the European Central Bank reached out to me personally, invited me to join their technology forum, technology roundtable, to participate in the euro, which is a 2-year R&D assessment to look at potentially bringing the euros into a digital currency. We sent our proposal to them, and hopefully we get some positive feedback on that in the coming months. But so yeah, single continental currencies are sort of on the radar of these central banks. But I think a global currency is even the next far-reaching idea, but even a better idea. And we want to bring a global currency to trade. We're going to start with the G7 and the G20 coin.
And Jeff, one other point on this that I think is really important to understand. When you use the term global currency, that tends to cause some people to get nervous, right? Do you want to talk before you jump into this one, do you want to talk a little bit about why having essentially being in network, right, essentially protects from SEC and the whole issue of securities, because the in-network component is a really important component of this.
And definitely, very good point. So first of all, only banks can issue currency or money, right? So if you regulate it under the banking system, you can issue money and it's not considered a security. If you're a private enterprise and you issue what you maybe call a cryptocurrency or an index, in this case, a basket of currencies, that may very well be considered a security. So now, if you remember, Facebook tried, and failed miserably with the Libra project and trying to create one currency for the world, right? It didn't go off very well. But the reason is, the reason why that wouldn't work, and I advised Facebook on this. I had 2 or 3 calls with them about this project. Is one, they were trying to bring it to the retail sector. So if something is considered a security because it's not issued by the government, retailers can't purchase it without it being a security offering. So having the G7 coin, which has 7 different currencies as an index, many governments will very well see that as a security. So why does it work for global trade? Well, global trade, we're doing millions of dollars in transactions between institutional B2B accounts, and they are accredited investors, institutional investors. So even if it's considered a security, it's not an issue, it's not a roadblock, because it's not a retail play. So that's the nuance of this. So in the B2B model, a digital currency or index currency for global trade can easily work because we're dealing with institutional accounts. And even if it's deemed a security, they can purchase it and trade it without having the same issues of a retail using it for, buying coffee at Starbucks. That makes sense.
It doesn't. There's a question in the chat, Daryl. Michael, do you want to? Michael, do you want to just, or is that Michelle? Do you want to just go ahead and ask your question? Well, the question is, yeah.
Oh, hi. Okay, perfect. Yeah, I'm just quick question. So I know that the IRS now is trying to roll out the gains and try to collect some taxes on some of the, at least on the personal side. So I know with crypto, you're able to earn interest on the deposits and whatnot. And I'm guessing, earning interest on these coins would be beneficial to businesses, right? But when it comes time that there's regulation involved and the government wants to collect taxes on those, I wonder how that will shift the way they'll do business like this. And then I'm wondering if maybe a fee, if they start to impose a fee, will that help mitigate some of the tax burden? Because typically when you're paying tax on interest, is a set figure, right? And I'm wondering when it comes to that point, what the landscape will look like.
Sure. So earning interest on a currency is no different than earning interest in your savings account or earning profit from an investment. You would treat it the same way as any income gain, right? So there is nothing special about digital currency that requires special treatment or regulation different than what's already out there. So if you guys has been following the news around Coinbase, they introduced a sort of an income producing yield on their stable coin, and the SEC was all over that, and they end up having to retract it several months later, just a couple of months ago. And the reason, again, yield is Coinbase is not a bank. Only banks can issue savings or yield producing products that may fall within the regulatory framework that's not considered security to consumers. But if you're offering, the retail public and soliciting to the retail public an interest product, that's going to be, at least in the US, that's going to be considered security all day long. Again, the reason why this works well, because we're talking about digital trade. Now, if this idea were to roll out into the retail sector, it would probably have to evolve into a government issued model. But in the trade, which is business to business, and these are accredited or institutional accounts, we can offer a yield producing product, as well as a security global currency to them, because these are accredited institutional accounts, right? So it works in the B2B side totally different than this would not work in the retail side, at least in some countries like the US.
Interesting, thank you.
Yeah. Okay, so let me see what the next slide. Yeah, the fraud prevention. So let's talk about fraud prevention technology with digital currency. Trade, this raw materials and commodities is about $20 trillion a year in industry. But trade is fraud is pretty rampant in this industry as well. There's a lot of, buyers and sellers that imposter with cybersecurity, sophistication, they can almost simulate being Microsoft, sending out purchase orders, pretending you're dealing with a large company. Many times it's a total scam. I've seen all types and heard all types of stories. So therefore, banks, you look at step one, vet parties, banks spend an enormous amount of time. I've seen, 6 weeks to 3 months sometimes vetting an international account to get comfortable before they would give their buyer or seller approval to do business with the other side. Because of the fraud, it really makes the industry very inefficient, because banks handle most of the trade, the large trade deals through letters of credit type instruments. And they are very, slow in a vetting and due diligence process, and also verifying the shipment of goods. So the digital currency can speed that up, because we have the ability, similar to when you make a deposit into your checking or savings account, sometimes there's a hold on that deposit until the money clears. Where we have the similar technology in digital currency. I could send you $1 million with a hold, so the $1 million will show up in your wallet, but to show that the money is there, but you cannot transfer or liquidate that money until whatever the conditions are, the performance criteria are for that release, which could be the delivery and acceptance of the product, right? So that allows us to shift the burden to the inspection, which is the end of the process, versus the beginning, where they spend so much time trying to vet, and many times they still may be wrong, right? Because you vet for 3 months doesn't mean the bad actor is not more sophisticated than the bank, and it's been proven many times over. And once you send money through the fiat system, once it hits the bank account, those bad actors are shifting that money to the offshore accounts seconds later, right? So in 2 or 3 trails. So trying to trace and seize fraudulent transactions in the fiat world is very time consuming, and sometimes impossible, because of how sophisticated these bad actors are. But with this technology, you still should do basic vetting, of course, of both buyer and seller. But the extensiveness of which is done today would not be as required, because we have a safe proof mechanism to be able to send the money on hold and release it once the proof of product or the inspection process, whatever the performance criteria is on the delivery, are met. So normally you go through the vetting, you go through proof of funds. On the inspection, sometimes there's some release of funds. At that point, normally with these more complex trade deals, there could be a release of funds schedule, pay something on inspection, pay something on shipment, pay something on delivery, a transfer of ownership. So these are the process, but the key is this post-validation technology. So with the post-validation, what it's saying, yeah, we can pay you in these increment milestones, but until we receive the post-validation, when that's set into normally the SPLC, standby letter of credit, or whatever the terms are, that money cannot be transferred or liquidated to cash until then. So we can pay you, but it's a hold on that payment. And that's just that's just an optional feature. Now, every transaction does not have to be. Once you have an account, maybe you've been doing business with for years, or they've been vetting, you're comfortable, sure, you can transfer like any other transfer. I'm simply saying we have a feature that allows you to also do a transfer as with a hold, and then maybe you apply that feature for new accounts or for people who have not met certain criteria in their credit guidelines. So being able to send money with post validation technology is not something that's available in general ledger technology, Bitcoin. I shouldn't mention any other private company names, but this is not available in any public ledger technology today. But this is an innovation that the DCMA is bringing for our central banking and government type clients. Any questions on that?
Daryl, Jamal and Trevor have a question. Jamal, do you want to ask your question first? And then Trevor? It's also written in the chat, Daryl, if you have access to the chat.
Okay. Let me look there. Oh, wow, there's 9 posts there.
Sorry about that. I couldn't unmute properly for some reason.
No worries.
I was just asking, I definitely see there's a lot of benefits to part of this as going through as a transaction and whatnot. But I guess my question was like, is there a look and seeing the single global trade currency can coexist alongside fiat currency, or is this an all-in or kind of like nothing solution? Because
Yeah, no, it coexists. So it coexists. So with, for example, we have a proposal in front of the African Union right now for a single continental currency for Africa, similar to the euro. Africa has been trying to figure out how to do a single currency for over 20 years now, and every 5 years they set a date and they can't meet the date. The reason is, the situation in Africa is quite different in Europe, and so all the credit requirements they are putting on the central banks, they are not meeting them. And my proposal to them was, listen, instead of trying to do monetary integration across Africa and having all these Africans adopt one single currency, I said it took Europe 72 years to get to that point. Africa is much further, I shouldn't say back, but it's much earlier in their horizon to get to a point to be able to do monetary integration. So my proposal to them is to create the Afra currency, but they maintain each of their local currencies, and we create another single continental currency simply for digital trade as phase one, and we can evolve it to fiat and maybe retail down the road. But I think it needs to be so I'm suggesting a phased approach. B2B digital currency is a very easy use case to implement as a phase one. And of course, I see your question here about can individual investors hold it? Sure, the technology doesn't prevent individual investors from holding it and getting interest. This is more of a regulatory issue, right? So in some countries like the US, individual interest, as I said, would be a security. And even then it's possible, you just have to go through a different sort of process for them to be able to subscribe to that kind of an offer. So every jurisdiction will have a different way of implementing it. But our focus is digital trade in large accounts. So we are dealing with institutional accounts. So so in that case, almost in every scenario, they would be considered accredited or non-retailers. So they can purchase the digital currency and gain interest without having the same issues that a public or retail investor may have. Right.
Daryl, can I ask you a question on that subject?
Yeah.
So you and I were talking yesterday or the day before, and I think this was a conversation we had. We were talking about how when the Federal Reserve dropped reserve requirements to zero, then the banks could loan out as much money as they wanted to. And they weren't really paying interest on deposits because, quite frankly, they didn't need it, right? While the exchanges need the liquidity, so they're paying 5 to 30%, right? So there's the exchanges, or they're calling it staking fees, right? Interest, it's the same thing. But they need the money, so they're paying higher interest rates, right? Traditional retail banks don't need the money, so they're not paying a lot of interest rates. What's the incentive in a system like this? What are the incentives that would drive the interest rates?
Well, this is, again, this is a totally different scenario. This is more like central bank digital currency, right? So this is no different than the national currency model. So there would be no reason to have a different interest rate on a CBDC any different than the fiat version. This is not cryptocurrency. This would be official currency. CBDC is official currency issued by the central bank. Right now, this particular G7, that would be a little different because that's something that we are proposing. So no central bank has adopted that. So but the G7 the DCMA could issue the G7 coin, but we will only issue it to accredited investors. And our focus is trade. So we're not looking at this as a global public currency for people, again, to buy and purchase goods and services. Our focus is international trade, global trade, focus on commodities and raw materials. And these are all institutional accounts. So, but we would still offer an incentive of some interest, probably like 3 to 5% a year. We don't have to compete with a cryptocurrency kind of model, but the benefits is very clear. If you're in the trading world, those benefits I showed earlier, it's going back here. These will be the reasons why they would want to hold a global currency for these benefits. If you're a trader, and especially in many of these emerging market countries, right? A lot of these emerging markets are losing to the G7 countries almost monthly, if not annually, 5 to sometimes 10% a year, right? Mexico to the US, I think when it was when it first came out 20 years ago, the one US dollar had, you can get 3 pesos. Today, I think it's 21 pesos to $1. So a lot of these emerging market countries, it would be in their interest to hold their balance in a global currency, especially if it's tied to like a G7 or the G20, than their local currency, because they're losing almost year over year to the major market advanced economies. So
Wow.
the benefits are very compelling without the interest rate. But the interest rate would be just another enhanced benefit. But it doesn't have to compete with cryptocurrency in general. That's not the use case to compete with cryptocurrency. It's for those who's already doing trade and want the benefits that digital currency can bring to trade.
All right. Thanks, man.
Right. So good. So yeah, this is a feature fraud prevention is a very strong use case for why digital currency. And I also want to mention SPLC digital trading protocol. This is most of these large trade deals, again, controlled by banks through letters of credit. Normally you go to your bank to get a letter of credit for X million dollars to buy some goods from another buyer or seller on the other side who also has a bank. So there's a process currently with freight forwarders to be able to get what we call a bill of lading sign off once the product is delivered. And once that bill of lading is signed off by the freight forwarder to say, okay, this product was delivered, it met whatever the criteria was, the buyer or the seller sends that to the buyer's bank. And once it's verified and validated, then that bank pays the other side. Now that's done through just regular fiat payments today. How can digital currency improve that? So we built a protocol here, which I'll walk through, where with digital currency can make this a lot more efficient. For one, public ledger technology such as Bitcoin and others, they only do cash balances. These were meant for anonymous, sort of non-trusted, sending of money between unknown parties. In that case, it's only a cash ledger. In banking has many other types of ledgers, debt ledgers, right? Debit ledgers, credit ledgers, and various flavors of debt, investments, disbursements, all types of accounts. How do you handle that with public ledger technology? You simply can't. Especially think about overdraft. Banks makes a lot of money on overdraft, at least in the retail market. But sometimes you may want to extend a credit to a customer. So we learned very early on that public ledger technology is just not suitable for banking. Banking needs its own central bank digital currency, blockchain, or digital currency platform that can support all the ledger types, such as loans and lending. Right now, the way they do it on Ethereum and others is through smart contracts. So they build all types of smart contracts to implement enhanced functionality. But the problem with that is every company would build a smart contract differently. So there will be no standards, not very scalable, and part all types of security concerns, right? So the best solution would be if you can build a multi-dimensional ledger technology where not only cash is a ledger type, but debt and all the other forms of ledgers that the bank would need could be supported in the blockchain. I don't know anyone in the world who's done this other than the DCMA, who's implemented this type of multi-dimensional ledger technology that can support it. So we use our debt ledgers to implement this SPLC digital trading protocol I want to walk you through right now. So the way it will work, and anyone who implements our protocol can do this. So any portal like Alibaba or Amazon or any startup that wanted to do a trade finance portal or could implement our protocol for this service. So let me just walk you through how it works. So say it was, I'm going to say, now we have a sister company called UBI that has implemented this. So this is an example, but anyone can implement this. So I'm just going to use them as the example. So say a buyer and seller opens a fintech trade account, say on UBI. So both the buyer and seller are there. The buyer will have to upload from their advising bank, their SPLC. So we only use SPLCs, not letters of credit. Letters of credit, the buyer still has the authority to reject that letter of credit or to pull that letter of credit. an SPLC is guaranteed by the bank as long as the performance of the SPLC is met. So there is no recourse on the SPLC as long as, or at least that bank will be liable, legally responsible, legally liable. So we only accept SPLCs in our protocol, but I guess a portal could choose to possibly consider LOCs, but we wouldn't recommend it, right? Because SPLCs are guaranteed by the bank as long as the performance criteria are met. But say the buyer uploads their SPLC into their portal, that's reviewed. Once approved, the SPLC indicates the fintech as the beneficiary. Say it was UB portal that was doing this trade deal. So the reason why the fintech company needs to be a beneficiary in the SPLC, because we're going to give them digital currency, as you see in step 4. The fintech would deposit CBDC or digital currency into the buyer's trade account based on that SPLC. So we basically just give him a loan. His SPLC is basically his line of credit that's securing the digital currency that we're providing. So the fintech portal who's implementing this protocol should be the beneficiary of that SPLC. So once the goods are delivered, the bank pays back the fintech portal, right? Not the supplier. Because the fintech portal, you can see later, we end up paying the supplier early, right? So, so step 4, the fintech deposit the SPLC into the buyer's trade account based on an approved standby letter of credit. Then the buyer and seller executes the purchase agreement as usual with the proof of funds and the release of funds schedule, right? The proof of funds is SPLC and the digital currency is there, and whatever the release of funds schedule is. And the fintech pays the seller once the SPLC performance is met. So once say that the goods are inspected and delivered, we have the digital currency in the buyer's account, right? Because we gave them that based on their standby letter of credit. So once the goods are delivered, we don't have to wait for the bank to pay, right? We pay immediately. So this is an efficiency improvement now. But the banks take sometimes, they have some legal responsibilities. We've got the exact number of days right now, but they have some guidelines on how many days they should take to review that delivery at the port and pay it. But it's normally still a slow process, and normally they wait to the last, pretty much the last mile of that requirement timeline before they pay it. But in this case, we can once the freight forwarder forwards a bill of lading and show proof of delivery and all the criteria are met, the fintech company can pay the supplier based on the digital currency in their account without waiting for the bank to pay it. Then the fintech could refund the buyer if for some reason the performance is not met. So again, the SPLC is a performance-based trade which specifies what the conditions are, whether it's the port of delivery, the inspection criteria, et cetera. And the freight forwarder confirms that once it's completed. And if that is not met, we can easily refund the buyer back without any recourse or any penalty to the buyer, right? And the seller cannot transfer or liquidate the CBDC. Remember, I mentioned earlier being able to pay on hold. So the seller cannot transfer or liquidate the CBDC until the change of ownership validation is confirmed. So even though we pay the seller, until that change of ownership is confirmed, he cannot transfer or liquidate that money, right? But the seller can transfer and liquidate to the advisor bank after the change of ownership is confirmed. So that's pretty much the process. So basically, the CBDC is acting as a settlement currency in an intermediary between the advising bank and the issuing bank, right? So instead of waiting on those banks to fulfill their sort of inefficient process, once the fintech portal verifies and validates the SPLC, they issue digital currency as a loan. So but it's not going to their cash ledger, because it's going to their debt ledger, because they're actually basically lending them CBDC based on the SPLC that they uploaded to the portal. And then the bank, once that the product is delivered, then the bank will eventually pay the fintech portal, because as we saw in step 3, they are the beneficiary of the SPLC. And of course, they would charge a fee. So you say, well, why would the fintech portal take that risk? One, because we're trying to get the world to move the digital currency. This is sort of like an intermediary. I would call it a transitionary strategy to get people to comfortable with digital currency. I mean, ideally, over time, people would simply just buy the digital currency and transfer the digital currency using our hold technology. But we know the industry is, right now heavily invested in SPLCs, And it may be some time before they're comfortable simply buying the digital currency and using that technology directly. So we wanted to come up with a solution that we can basically backwards integrate into the way business is done today, to still leverage digital currency as a technology to make it more efficient.
I think that's brilliant. I want to bring Silvio up real quick, because Silvio's got some thoughts and comments. And Silvio is the GBA lead in Florida. And if you can imagine, Florida and Miami is they're ports to the world. So Silvio's got a lot of experience in international trade. Silvio, you want to share just a little what's your thoughts about what you've heard, and then just share a little bit about what you guys have done down in Florida?
Yeah, no, I'm loving this, Gerard. Thank you so much for the introduction. I think that this is a wonderful presentation. You've done a really wonderful job explaining and understanding a very complex and complicated subject, not just on the traditional side, but also on the technical side of technology and where it's going. So I think that, definitely excellent work on the way you've handled that. I'm curious to hear how you're. I think here in Florida, I think just to Gerard's point, to give you some context, we do about $100 billion of trade just between the port of Miami, port and the seaport. And we are actively working on more innovative solutions, because, I think a lot of the banks here are more focused around real estate, for example, and less about international trade. Moreover, what we are seeing is that there's just that's probably going to be a trend that's going to increase, because Basel as not Miami Art Basel, but Basel as in the Basel Switzerland banking regulation requirements for liquidity, banking liquidity ratio requirements, have forced a lot of the banks that have historically been the ones that have played a role in international trade finance, standby letters of credit, confirmations, and other things of this type that go into international trade. And we've seen a lot of other sort of backups that have happened where traditional firms now are not wanting to do these kinds of deals. And so we're seeing there's a big spread going over to private alternative asset managers, right? Things like groups like hedge funds, for example, or international trade funds that just solely focus on this. So what I'm curious to see is like, what's the is there an insurance policy or something that's related to this component? I think that usually, for example, if it's a traditional bank that's doing a transaction and I'm a US exporter, then these banks will typically have an EXIM guarantee, or the company will have an EXIM guarantee, which makes the deal more likely or more appealing or more interesting. There's also, that's only for which I think is one dynamic. But for a place like Miami and Florida, for example, we do a lot of trade with places like, let's say, Africa and Latin America. That changes when this whole trade finance dynamic changes when you start importing from poorer countries that don't have necessarily the credit rating, credit risk, credit history, or just like data that's available in general to how the transactions are being done. So I'm just curious to see sort of these elements and how they're working. And then lastly, it's as we're developing some of the smart logistics protocols between the ports, for example, we've been developing some smart city projects and initiatives. What would it look like if we put Internet of Things and other things on the seaport and the airport that can further accelerate this process? So now you don't have to validate, you don't need necessarily a bill of lading to prove that the thing has arrived. You might be able to digitize the bill of lading process, the receipt of the goods when they hit the port and they arrive at the port, versus having to wait for other things. I'm not sure if that's also considered, Daryl. And by the way, I run a trade finance firm called Logos Capital. So a lot of what we've been doing is international trade between Latin America, the US, Asia, Africa, and Middle East, and et cetera. So very interested, obviously, in the topic of international trade as an investor, as a lender, as a trader, and also just someone as a civilian that's just supporting technology infrastructure that can further add insight to streamline the international trade processes. But they're all really impressed, I think, with the presentation and the approach here. You mentioned that somebody else has already integrated it. We'd be interested, not just for myself, but for the rest of the crowd, what it might look like, to have some of these integrations. So I'm throwing a couple of things out there. Gerard, I'll just take a pause and look at you to see if these are some of the points that you had in mind to mention in terms of trade. And if there's if I've covered all the points, maybe Daryl, if you want to take some of these bite size, and I've thrown a lot of questions your way.
Guys, let me throw two things out. First of all, Sylvia, I would like you to mention really briefly when I'm done with what I have to say, the work that you've done with the Port Authority, the rail, and the land, and the airports, the logistics work that you've done. Secondly, I need to apologize because we had originally planned this to be a 2-hour call. Unfortunately, we had to cut it down to a 1-hour call because of another conflict, which I couldn't. So normally we would be at the point now where we really kind of move into Q&A. But I tell you what we will do. We will definitely continue this conversation. I'll schedule another one of these. Daryl, I'll talk to you to see when we schedule another one. We'll definitely do one the first week in February. We can see about doing another one in between. In the meantime, if you would like to connect with anybody else on the call, if you would put your contact information, well, I'll keep the call open for another couple of minutes so everybody can scrape it. But if you'd like to talk to Daryl, Daryl and Sylvia, you guys definitely should talk to each other. But Sylvia, can you just share a little bit about what you've done with logistically in Miami? And then unfortunately, I am going to have to shut the call down, sadly.
No problem. I just went ahead and posted my email in the chat. Daryl would certainly love to connect with you before January on some of these things. Jump into Gerard's point. It's we're doing here. We're seeing that the U.S. in general is very behind in terms of port digitization efforts compared to the port of Shanghai, compared to the port of Dubai, the port of Marseille, the port of Rotterdam, all these other ports that are already very digital ready, blockchain type ready ports. We've been doing the same efforts here the last few years. And that goal has been really doing a partnership with the Economic Development Agency for the county, Miami-Dade County. For those of you who don't know, Miami-Dade County is made up of 33 different cities. Depends on whether you or not you count unincorporated Dade or whoever's trying to become a new city under unincorporated Dade, City of Miami being the largest one. But the county controls the ports, meaning the seaport and the airport. Primarily, those are county operated assets, which are not, in some, depends on what jurisdictions are in, may or may not be common. That being said, 2 years ago, we started doing a training program. I would say training program. I would say more of webinars. We started hosting these workshops at each one of the multimodal stakeholders in the South Florida community. Starting first with the kickoff event in partnership with the Economic Development Agency's Logistics Committee. Then that was just like a broad overview of innovation, smart cities, and blockchain, and what's necessary for that. From there, we went on to the Freight Forwarders Association to also educate them and then bring technology that's more relevant for that segment of the stakeholder market in the supply chain and logistics and international trade field. Went up, educated, gave some tools, gave some examples of how these people can improve their businesses, invited technology solutions for each one, then to the airport, then to the seaport, then to the trains. So we feel that through Gerard, to Gerard's support, we were then able to connect with Orlando and some of the Congressman DeSoto's office in Orlando to say, okay, this is the smart city stuff we're doing in South Florida. And they said, well, please help, think about connecting this to up to the Orlando area. And so now we've turned it into a smart city project for Miami, into a smart state project for Smart Florida, but it's really, really grassroots on an organizational level. However, it's also allowed us to spread some of this knowledge and educational content around blockchain applications to the Airport Society at large through the Airport Research Cooperative Program, which is, for those of you that might know, is the innovation council, if you will, for the council of all the airports globally, which happens to be co-chaired by the wonderful Jamaican-American Maurice Jenkins, which is one of the CIOs of Miami International Airport, which helps in terms of just, bringing awareness of blockchain to the aviation space.
Hey, Sylvia, I apologize. I got a hard stop because I got another call that's going to be using this line.
Okay.
I want to listen. I can't say enough about how proud and humbled and honored I am to have folks like you all be part of this network. You guys have been doing great work for a long time. We're going to continue to try to connect people together. And this is just the beginning. If you haven't done it already, please come to our event in January, and Daryl, I'll circle back with you. We can schedule the next event. Like maybe we have you and Silvio together. Maybe we bring Juan on as well. So you guys have a great bodacious day, and thank you all so much for being a part of this.
Okay,
Thank you so much for hosting this. Great job, Gerard.
Bye, everybody.
Thank you, Darrell.
Thank you.
All right,
You
guys,
too,
have a
Zach.
wonderful one.